Before we begin, please remember that this presentation is for informational and educational purposes only. I am not a financial advisor, mortgage broker, or attorney. The information provided in this video is not a substitute for professional advice from a qualified expert. Always consult with licensed professionals before making any financial decisions related to real estate or mortgages. Imagine two investors. Let's call them Sarah and Tom. Both are smart, ambitious, and ready to build wealth through real estate. They each find an identical rental property in a growing American suburb, both listed for exactly $250,000. They both put 20% down. They both get a property manager. 5 years go by. Sarah is now buying her fourth and fifth rental properties. Her cash flow is exploding, and she's on a clear path to financial freedom. Tom is struggling. He's barely breaking even on that first property, constantly stressed about expenses, and is seriously considering selling at a loss just to get out. What was the difference? It wasn't the house. It wasn't the tenant. It wasn't the market. The difference, the single variable that created two completely different destinies, was the loan. The mortgage, that stack of papers they each signed, which most people just see as a necessary evil, is the most powerful and most dangerous tool in an investor's entire arsenal. And the shocking truth is most Americans, even savvy investors, fundamentally misunderstand it. They focus 100% of their energy on finding the right property and spend maybe 5% of their time understanding the financial engine that will actually power it. This is not just another video about interest rates. This is a complete 10-part masterclass designed for one purpose: to turn you into a master of the American mortgage system. We are going to deconstruct the entire process from the ground up. We'll expose the hidden fees, decode the confusing jargon, and reveal the insider strategies that separate amateur investors from the pros who build empires. By the end of this series, you will have the knowledge and confidence to walk into any bank or lender, not as a hopeful applicant, but as a sophisticated investor who knows exactly what they want, why they want it, and how to get it. You will learn how to structure a loan that doesn't just buy you a property, but actively accelerates your wealth creation. This is the skill that separates the Sarahs from the Toms. This is the knowledge that transforms a simple house into a high-performance financial asset. So, let's start at the very beginning with the single most important concept in all of real estate investing. It's a concept so powerful it feels like a cheat code for wealth. It's called leverage. At its core, leverage is the art of using other people's money, in this case the bank's money, to control a large asset and magnify your returns. Think about it this way. If you wanted to buy that $250,000 property with all cash, you'd need to have $250,000 sitting in your bank account. You write the check, you own the property. Simple. Let's say that property appreciates by 5% in the first year. That's a fairly conservative number for many markets. Your $250,000 investment is now worth $262,500. You made $12,500, a 5% return on your cash. Not bad, but not life-changing. Now let's use the power of leverage. Instead of paying all cash, you go to a lender and get a mortgage. You put down 20%, which is $50,000. The bank lends you the other $200,000. You still control the entire $250,000 asset, but you only have $50,000 of your own money in the deal. Now let's run the same scenario. The property appreciates by that same 5%. It's still worth $262,500. You still made that same $12,500 in equity. But here's the magic. You didn't make that profit on the full $250,000. You made it on your initial $50,000 investment. So what's your return? You take your profit, $12,500, and divide it by your actual cash investment, $50,000. Your cash-on-cash return from appreciation alone is a staggering 25%. Look at those numbers again. Same property, same market, same appreciation. One investor gets a 5% return. The other gets a 25% return. That is the raw, undeniable power of leverage. You use the bank's money to amplify your results by a factor of 5. This is how fortunes are built in real estate. It's not about saving up for 30 years to buy one property with cash. It's about intelligently using the banking system to control multiple properties, magnify your gains, and accelerate your journey to wealth. But this power comes with a cost, and it's managed through 4 critical components that make up your monthly payment. You need to burn this into your brain. It's an acronym: PITI. P-I-T-I. Principal, interest, taxes, and insurance. Principal is the easy part. That's the actual money you borrowed. Every time you make a principal payment, you are paying down your loan balance and increasing your ownership stake, your equity in the property. Interest is the cost of borrowing the bank's money. It's the fee you pay for the privilege of using their massive pile of cash to generate your 25% return. We're going to dedicate entire future parts of this series to dissecting interest, because mastering it is a key to winning the game. Taxes. These are the property taxes you pay to your local government, your city, your county. The lender often collects this from you as part of your monthly payment and holds it in an account called escrow, paying the bill on your behalf when it's due. They do this because they have a massive financial stake in your property, and they want to make absolutely sure the government doesn't put a lien on it for unpaid taxes. And finally, insurance. This is your homeowner's insurance policy. It protects the property against things like fire, storms, and other disasters. Just like with taxes, the lender insists on this and usually collects it in your monthly escrow payment. Why? Because if the house burns down, they want to be sure their $200,000 investment is protected and can be rebuilt. Pity. Principal, interest, taxes, insurance. These are the four pillars of your mortgage payment. Understanding how they work together, how they can be manipulated, and how they impact your bottom line is the foundation of everything we are going to build on in this series. Without a deep understanding of pity, you are flying blind. So we've established that leverage through a mortgage is the rocket fuel for real estate investing. It's how you turn a 5% return into a 25% return. And we know that this rocket fuel is delivered through a monthly payment comprised of pity. But there's a catch. There's a hidden component that can sneak into your payment, especially for investors who don't put down a large amount of cash. It's a silent wealth killer that benefits only the lender and provides almost zero value to you. It's a parasitic fee that can add hundreds of dollars to your monthly payment, absolutely destroying your cash flow and crippling your investment from day one. Now that you understand the incredible power of leverage, you need to understand its dark side. You need to understand the hidden trap that snares millions of first-time homebuyers and investors. It has an innocent-sounding name, but it is one of the most expensive mistakes you can make. It's called private mortgage insurance, or PMI. And in the next part, we are going to expose exactly what it is, why lenders force you to pay it, and most importantly, the strategies you can use to avoid it entirely, potentially saving you tens of thousands of dollars over the life of your loan. It's a fee that feels like a penalty for not having a massive 20% down payment sitting in your bank account. It's called private mortgage insurance, or PMI, and it's one of the most misunderstood and most resented expenses in the entire home buying process. Think of it this way: PMI is not insurance for you. It doesn't protect you if you lose your job or can't make a payment. It's insurance that you are forced to buy to protect the lender. You pay the premium and the bank gets the payout if you default. It's a fantastic deal for them. So why does this exist? From the lender's perspective, it's all about risk. For decades, the gold standard for a mortgage was a 20% down payment. Why 20%? Because a borrower who puts that much of their own money into a property is seen as having significant skin in the game. They are far less likely to walk away from the loan because they'd be walking away from a huge chunk of their own cash. When you put down less than 20%, say 5% or 10%, the lender views you as a higher risk. If the housing market dips and you have to sell, there might not be enough equity to cover the entire loan balance after closing costs. That's where PMI comes in. It's the lender's safety net, a policy that covers their potential losses, and they make you pay for it. The cost of this safety net is not trivial. PMI typically costs between 0.5% to 1.5% of the original loan amount per year. Now that percentage sounds small, but let's translate that into real American dollars. Let's say you're buying a property and taking out a $400,000 loan. At a 1% PMI rate, you're paying an extra $4,000 per year. That's an extra $333 tacked onto your mortgage payment every single month. What could you do with an extra $333 a month? That's a car payment. That's a significant portion of your family's grocery bill. It's a student loan payment. Instead, that money vanishes into the ether, providing you with zero direct benefit, all to make your lender feel more comfortable. Over 5 years, that's $20,000. Gone. It doesn't build your equity. It doesn't pay down your principal. It's purely a cost of borrowing. And you have to be careful because not all mortgage insurance is created equal. On conventional loans, it's called PMI. But if you get an FHA loan, which is popular with first-time buyers because of its low down payment requirements, you'll pay something called a mortgage insurance premium, or MIP. FHA's MIP is often even more expensive, and here's the critical difference. On many FHA loans, you pay that MIP for the entire life of the loan. It never goes away unless you refinance. That $333 a month could follow you for 30 years. That's over $120,000 paid for an insurance policy that doesn't even protect you. Now that you understand the enemy, let's talk about how to defeat it. Because paying PMI is not an inevitability. It is a choice, and you can choose to avoid it. The first and most obvious strategy is to simply put down 20%. This is the brute force method. You save aggressively, you get a gift from a family member for the down payment, or you use proceeds from the sale of another property. If you can walk into the bank with that 20% down, PMI is a non-issue. The conversation never even comes up. But for many American investors, especially those starting out, coming up with that much cash is a monumental challenge. A 20% down payment on a $500,000 property is $100,000, plus you still need cash for closing costs. So while this is the cleanest path, it's often the most difficult. This brings us to strategy number 2, a far more clever and accessible method: the piggyback loan. This is a classic investor move that banks don't often advertise. It's also known as an October 10th 80 loan. Here's how it works. Instead of getting one giant loan for 90% of the home's value, you get 2 separate loans. The first mortgage is for 80% of the purchase price. Because this primary loan is at that magic 80% threshold, it has no PMI requirement. The second loan, the piggyback, is for 10% of the purchase price. This is often a home equity line of credit, or HELOC. You then put down the remaining 10% in cash. So, you get into the property with only 10% down, but you completely sidestep PMI. The math is simple. 80% first mortgage, 10% second mortgage, 10% your cash. No PMI. Now, the interest rate on that second 10% loan will likely be higher than your primary mortgage rate, but you need to do the math. Very often, the total monthly payment for both loans is still less than the payment for one large loan plus PMI. And even better, the interest on both of those loans is typically tax deductible, whereas PMI often is not. Next, a word of warning about strategy number 3, which is more of a trap to avoid: lender-paid mortgage insurance, or LPMI. This sounds great on the surface. The lender says, "Hey, don't worry about a monthly PMI payment, we'll take care of it for you." But there is no free lunch. Ever. What they're actually doing is giving you a higher interest rate on your mortgage for the entire life of the loan. They might bump your rate from, say, 6.5% to 6.875%. It seems small, but that slightly higher rate means you're paying thousands, or even tens of thousands of dollars in extra interest over 30 years. And unlike traditional PMI, you can't get rid of it once you reach 20% equity. It's baked into your rate forever unless you refinance. LPMI is almost always a bad deal for the borrower. A classic case of the bank hiding a long-term cost behind a short-term convenience. Finally, strategy 4 is to seek out specialized loan programs that don't require PMI. The most well-known is the VA loan, a phenomenal benefit for active-duty military and veterans. VA loans require 0 down payment and have no monthly mortgage insurance. If you are eligible, this is almost always your best option. Some credit unions and banks also offer special portfolio loans for professionals like doctors or lawyers, which may have low down payment options without PMI because they see these borrowers as very low risk. It pays to shop around beyond the big national banks. But what if you're already in a loan and you're paying PMI every single month? Are you stuck? Absolutely not. You have a battle plan here too. Thanks to the Federal Homeowners Protection Act, your lender is legally required to automatically terminate your PMI on the date when your principal balance is scheduled to reach 78% of the original value of your home. They have to do this even if you do nothing, but you should never wait for that. You can be proactive. Once your loan balance drops to 80% of the home's original value through your regular payments, you have the right to request, in writing, that your lender cancel your PMI. They have to grant it, provided you have a good payment history. But here's the real pro tip, the one that can save you years of payments. You can also request PMI removal based on the current market value of your home. Let's say you bought a house 3 years ago for $400,000, and your loan is $360,000. But the market in your area has been hot, and a new appraisal shows your house is now worth $500,000. Your loan of $360,000 is now only 72% of your home's current value. You are well past the 80% threshold. In this scenario, you can contact your lender, pay for a new appraisal, and if the numbers work out, they will drop the PMI. This single move can save you thousands of dollars just by paying attention to your local real estate market. PMI isn't a life sentence. It's a temporary cost associated with a low down payment. By understanding what it is, why it exists, and the multiple strategies to avoid or eliminate it, you are taking control of your investment. You're moving from a passive homebuyer to an active, informed investor who doesn't pay a single dollar more than necessary. We've just demystified the hidden cost of PMI. But all of these strategies, avoiding PMI, getting it removed, even getting approved for the loan in the first place, they all hinge on one single critical metric. It's a number that lenders use as their ultimate measuring stick for risk. It's called the loan-to-value ratio, or LTV. This ratio is the master key. It unlocks everything. It's the one number that dictates the bank's entire perception of you as a borrower and as an investor. And in the next part, we are going to break down exactly what LTV is, how it's calculated, and how you can manipulate it to your advantage to get the best possible terms on any loan every single time. LTV, or loan-to-value, is the single most important number a lender sees when they look at your loan application. Forget your life story, forget your brilliant investment thesis for a moment. To a lender, you are a collection of numbers, and LTV is the headline. It tells them, in one clean percentage, how much of your own money you have at risk versus how much of their money is at risk. It's the ultimate measure of your skin in the game. Imagine you ask a friend to lend you $100 to bet on a horse. If you put in $1 of your own money and ask him for the other 99, how does he feel? Terrified. You have almost nothing to lose. If the horse stumbles, you're out $1. He's out 99. Now, what if you put in 50 of your own dollars and only ask him for the other 50? Suddenly, he's much more interested. You're sharing the risk equally. You're a partner, not just a liability. That, in its simplest form, is the psychology behind loan-to-value. The calculation itself is brutally simple. It's the loan amount divided by the appraised value of the property. So if you're buying a property that appraises for $500,000, and you're asking for a $400,000 loan, you divide $400,000 by $500,000. That gives you 0.80, or an 80% LTV. This means the bank is on the hook for 80% of the property's value, and you are covering the remaining 20% with your down payment. That 20% is your skin in the game. It's your equity. It's the cushion that protects the bank if things go wrong. If you default on the loan and the bank has to foreclose, they know the property's value can drop by a full 20% before they start losing their own money. This single number directly and powerfully influences every aspect of your loan. A lower LTV screams safety to a lender. It makes you a premium borrower. And premium borrowers get premium terms. We're talking lower interest rates. The difference between an 80% LTV and a 75% LTV might not sound like much, but it could easily be a quarter of a percentage point on your interest rate. On a $500,000 loan, that quarter point can save you over $50,000 in interest over the life of a 30-year mortgage. $50,000, just for having a little more skin in the game. But the most immediate and painful consequence of a high LTV is something every investor dreads: PMI, or private mortgage insurance. If you're getting a conventional loan and your LTV is above 80%, meaning your down payment is less than 20%, the lender will almost certainly require you to pay PMI. Let's be crystal clear about what PMI is. It is not insurance for you. It does not protect you if you lose your job or can't make payments. PMI is an insurance policy that you are forced to buy to protect the lender in case you default. You are paying a monthly premium for the bank's peace of mind. It's like being forced to buy your landlord a new security system for his own house. It offers you zero benefit and can add hundreds of dollars to your monthly payment, absolutely destroying your cash flow on an investment property. The 80% LTV mark is the magic line in the sand. Get below it and PMI disappears. So how do we, as savvy investors, control this number? How do we manipulate LTV to our advantage? You have three primary levers to pull. The first and most straightforward lever is the down payment. This is the brute force method. The more cash you bring to the table, the lower your loan amount and therefore the lower your LTV. Let's go back to our $500,000 property. A $100,000 down payment gets you a $400,000 loan and an 80% LTV. No PMI. Good rate. But what if you scrounge up another $25,000? Now your down payment is $125,000. Your loan is only $375,000. Your LTV just dropped to 75%. You've now moved into a new tier of safety in the lender's eyes. You're not just avoiding PMI. You're actively qualifying for better interest rates and more favorable terms. The trade-off, of course, is liquidity. That extra 25 grand is now tied up in the property as equity instead of sitting in your bank account, ready for the next deal or an emergency repair. It's a classic battle between cash flow and capital preservation. The second lever is more subtle, but far more powerful for dealmakers. Negotiate a lower purchase price. Most people think the LTV is based on what you pay for the house. It's not. It's based on the appraised value or the purchase price, whichever is lower. This is a critical distinction. Let's say that $500,000 property appraises for its asking price. But you're a great negotiator. You find some leverage, maybe the seller is in a hurry, or the inspection revealed some minor issues, and you get them to accept an offer of $480,000. Now, to hit that magic 80% LTV, you don't need a $100,000 down payment anymore. You only need 20% of $480,000, which is $96,000. You just saved $4,000 in cash out of pocket while still securing the exact same 80% LTV. By lowering the purchase price, you lowered the entire financial foundation of the deal, making it easier and cheaper to achieve your target LTV. The third lever is the most advanced. It's where professional investors make their fortunes, and that is to increase the property's appraised value. This is less about the initial purchase and more about strategic positioning and refinancing. When you buy a property, especially one that needs work, you have the opportunity to force appreciation. Let's say you buy a distressed property for $300,000. It appraises for $300,000 and you get a loan for $240,000, an 80% LTV. But then you go in and spend $50,000 on a new kitchen, new bathrooms, and modern flooring. You've transformed the place. 6 months later, you go to refinance. A new appraiser comes out and based on the beautiful renovations and updated comparable sales, they appraise the property at $400,000. Now, when you refinance, the LTV isn't based on your old purchase price. It's based on this new higher value. You could potentially take out a new loan for $320,000, which is 80% of the new $400,000 value. This pays off your original $240,000 loan, repays you the $50,000 you spent on renovations, and even puts $30,000 of tax-free cash back in your pocket. This is the heart of the famous BRRR strategy: buy, rehab, rent, refinance, repeat. You manipulated the value upward to create a favorable LTV for your refinance. Think of two investors, Sarah and Tom. Both are looking at similar duplexes in the same neighborhood, each listed for $400,000. Tom is in a hurry. He offers full price, scrapes together the bare minimum 5% down payment, which is $20,000. His loan is for $380,000, giving him a 95% LTV. The bank sees him as high risk. They approve him, but they stick him with a high interest rate and a hefty $300 monthly PMI payment that eats into his rental income. Sarah is more patient. She negotiates the price down to $385,000. She puts down 20%, which is $77,000. Her loan is for $308,000. Her LTV is a solid 80%. She pays no PMI. Her interest rate is a half point lower than Tom's. Month after month, Sarah's mortgage payment is nearly $500 less than Tom's on a nearly identical property. Over 5 years, she will have saved $30,000. Her cash flow is stronger, her risk is lower, and her equity is growing faster. Tom is paying the bank. Sarah is paying herself. All because she understood and controlled the LTV. Mastering LTV is about understanding that you have more control than you think. It's not just a number the bank assigns to you. It's a number you can build, shape, and design to fit your strategy by adjusting your down payment, negotiating the purchase price, and forcing appreciation. It's the difference between being a passenger in the lending process and being the pilot. So you've mastered LTV, you've got the skin in the game part down. But what about your ability to actually handle the monthly payments? That's where the lender looks at the second critical number in their holy trinity of risk assessment: your debt-to-income ratio. It's the number that tells them if you're swimming in cash flow or drowning in debt. And in the next part, we're going to expose how lenders calculate it, the secret front-end and back-end ratios they use, and how you can legally and ethically present your income and debts to make you look like the safest bet they've ever seen. So let's pull back the curtain. When a lender looks at you, they aren't just seeing a person. They see a set of numbers, a risk profile. And the most critical number they use to judge you is your debt-to-income ratio, or DTI. Think of it as your financial blood pressure. Too high and the alarms start blaring. DTI is the single biggest reason qualified high-income people get denied for loans they think they can easily afford. It's a simple formula, but its implications are massive. It's your total monthly debt payments divided by your total monthly gross income, expressed as a percentage. But here's the secret. Lenders don't just look at one DTI. They look at two. And understanding both is the key to unlocking their vault. The first one is called the front-end ratio or the housing ratio. This is the simpler of the two. It looks at one thing and one thing only, your proposed housing payment. This isn't just the mortgage principal and interest. It's what the industry calls PITI. Principal, interest, taxes, and insurance. Lenders lump all four of those together to get your total monthly housing cost. Then they divide that PITI payment by your gross monthly income. That's your income before any taxes are taken out. Let's make this real. Say you make $120,000 a year. Your gross monthly income is $10,000. Now, let's say the investment property you want to buy will have a total PITI payment of $2,500 per month. The lender takes that $2,500, divides it by your $10,000 in income, and gets 0.25. As a percentage, that's 25%. For most conventional loans, lenders want to see this front-end ratio at or below 28%. So, at 25%, you're looking golden. You're in the safe zone. This number tells the lender, even before we consider their other bills, this person can comfortably handle the roof over their head. It's the first gate and you just walked right through it. But the second gate, that's where most investors get stuck. This brings us to the back-end ratio. This is the big one. This is the number that truly determines your fate. The back-end ratio takes everything into account. It starts with your proposed PITI, that $2,500 from our example, and then it adds on every other monthly debt payment that shows up on your credit report. We're talking car payments, student loans, personal loans, and the minimum monthly payments on all your credit cards. Let's say you have a $500 car payment, a $300 student loan payment, and your combined credit card minimums are $100. The lender adds it all up. $2,500 for the house, plus $500 for the car, plus $300 for the student loan, plus $100 for the cards. Your total monthly debt obligation is now $3,400. The lender then takes that number and divides it by the same gross monthly income of $10,000. $3,400 divided by $10,000 is 0.34, or 34%. This is your back-end DTI. Now, the magic number here is a little more flexible, but for a long time, the gold standard for a conventional loan was 36%. In recent years, that has crept up. Now, you can often get approved with a DTI as high as 43%, and for some government-backed loans like an FHA loan, sometimes even up to 50%. But every point you go over 43% on a conventional loan, you become a bigger risk. The lender's algorithm starts flashing yellow, then red. At 34% in our example, you're still in great shape. You've passed both tests, but you can see how quickly this can get out of hand. If your car payment was a little higher, or you had another personal loan, you could easily tip over that 43% threshold and get an instant denial, leaving you confused and frustrated. So, now that you know the secret code lenders use to judge you, how do you rig the game in your favor? How do you legally and ethically polish your numbers so you look like the safest investment they've ever seen? It comes down to a two-pronged attack: maximizing the I for income and crushing the D for debt. Let's start with income. The most important word here is verifiable. That 20 grand you made on a side hustle that was all cash? As far as the lender is concerned, it doesn't exist. You need to prove it, and the gold standard for proof is 2 years of consistency. If you have a W-2 job, this is easy. They'll look at your pay stubs and W-2s. But what about bonuses or commissions? If you can show a 2-year history of receiving them, most lenders will average them out and add it to your monthly income. This is huge. Don't just submit your base salary. Provide the documentation for every single dollar you've consistently earned. Now, for the self-employed investors out there, this is where you need to listen closely. For years, you and your accountant have been playing a game with the IRS. The goal is to claim every possible deduction to lower your taxable income. You write off your car, your home office, your meals, your travel. You feel like a genius on tax day. But when you walk into a bank, that genius strategy makes you look broke. The lender doesn't care about your gross revenue. They care about the net income you claimed after all those beautiful deductions. You've spent years telling the government you made as little as possible, and now you're trying to convince a lender you're making a fortune. You can't have it both ways. The solution? You have to play the long game. If you plan on buying an investment property in the next 2 years, you need to have a serious talk with your accountant. It might be strategically brilliant to take fewer deductions, show a higher net income, and pay a bit more in taxes for 2 years. That temporary pain can be the difference between getting a $300,000 loan or getting nothing at all. You're not just preparing your finances, you're preparing your story. Now for the second prong of the attack, crushing your debt. This isn't about becoming debt-free overnight. It's about surgery, not amputation. Remember, lenders are looking at your monthly payments, not your total debt balances. This is a critical distinction. Let's say you have a $5,000 personal loan with a $200 monthly payment and a $20,000 student loan with a $250 monthly payment. Common sense tells you to throw extra cash at the high-balance student loan. But for the purpose of qualifying for a mortgage, that's the wrong move. Your goal is to eliminate entire payment lines from your DTI calculation. You need to become a ratio surgeon. Look at your debts. Which ones can you kill off completely in the next 3 to 6 months? Maybe you have a small retail credit card with a $25 minimum payment, or a personal loan with only $800 left on it and a $100 monthly payment. Attacking these small, annoying debts with laser focus is the key. Paying off that $800 loan doesn't just reduce your debt, it completely removes a $100 a month liability from your DTI calculation. That $100 over the course of a 30-year mortgage could be the difference that lets you qualify for an extra $20,000 in loan money. Here's an inside tip most people never hear about: the 10-month rule. Some, not all, conventional loan underwriters have a guideline where they may disregard an installment loan if it has 10 or fewer payments remaining. This isn't a guarantee, but it's a powerful strategy. If you have a car loan with 12 payments left, making 2 extra principal payments to get it down to 10 could potentially make that entire monthly payment vanish from the lender's calculation. You must ask your loan officer specifically about this, as it varies, but it's a question that shows you've done your homework. By strategically paying off small debts to remove their monthly payments, and by meticulously documenting every verifiable dollar of your income for the past 2 years, you are actively reshaping how the lender sees you. You're moving from a fuzzy, high-risk snapshot to a crystal-clear, low-risk portrait of a reliable investor. You're not just applying for a loan, you're building a case. You are presenting an argument, backed by irrefutable evidence, that you are the safest bet on their books. This DTI ratio is the bedrock of your application. It's more important than the money you have in the bank, and in many cases it's just as important as your credit score. But your credit score, that's a whole different beast. It's not just one number. It's a story of your entire financial life told in an instant. And just like your DTI, it can be shaped, molded, and improved far faster than you think. The 3-digit number you see on a free credit website is just the cover of the book. The real secrets are in the chapters inside, the specific factors that lenders weigh most heavily. And in the next part, we're going to dive into that 3-digit number and expose the hidden mechanics behind it. I'll show you the difference between what you think builds your score and what actually makes underwriters say yes, and reveal a simple 30-day strategy to boost the key factors that can unlock lower interest rates and higher loan amounts. Let's start with the hard truth. Most of what you've been told about building credit is either wrong or, more dangerously, incomplete. It's advice for getting a new credit card, not for securing a 6-figure mortgage on an investment property. The two are worlds apart. A credit card company is betting a few $1,000s on you. A mortgage lender is betting a few $100,000 for 30 years. Their definition of risk is on a completely different level. They don't just look at your FICO score. They look through it. They're looking for the story behind the number. And that story is what gets you approved or denied. So forget the generic advice you've heard. We're going to focus on the 3 pillars of your credit report that an underwriter magnifies with a microscope. Master these and you master the game. Pillar number 1, and it is by far the most important, is your payment history. This accounts for a massive 35% of your score. Think of it this way: your payment history is your financial integrity. It's your resume of keeping your promises. To an underwriter, one late payment in the last 12 to 24 months isn't just a mistake. It's a giant flashing red light. It suggests that when things get tight, you might not be able to handle your obligations. A 30-day late payment can drop your score by 60 to over 100 points. A 60 or 90-day late payment, that can be catastrophic, potentially taking you out of the running for a good loan entirely for years. So what's the takeaway here? It's not just pay your bills on time. It's that you must guard your payment history like it's a priceless asset, because financially it is. Set up autopay on everything. Set calendar alerts a week before the due date as a backup. There is zero room for error here. If you have a legitimate late payment on your record from a year ago, you can try writing a goodwill letter to the creditor, explaining the situation and asking for a removal. It's a long shot, but it's a shot worth taking. But for the future, a perfect payment history is non-negotiable. Pillar number 2 is your credit utilization ratio. This is the secret killer of mortgage applications. It accounts for 30% of your score, and it's the factor you can change the fastest. Your utilization is simply how much credit you're using compared to how much you have available. If you have one credit card with a $10,000 limit and a $5,000 balance, your utilization on that card is 50%. Here's the inside baseball. Lenders see high utilization as a sign of financial distress. It tells them you're living on the edge, relying on credit to get by. Someone with maxed out credit cards is a much higher risk for a mortgage than someone who uses their credit sparingly. The general rule of thumb is to keep your utilization below 30%. But for a mortgage application, the pros aim for under 10%. Yes, single digits. The difference in your credit score between a 49% utilization and a 9% utilization can be staggering. We're talking about a potential 30, 40, or even 50-point swing in a short period of time. And this applies to each individual card and your overall total. You could have a low overall utilization, but if one card is maxed out, that single account can drag your score down. Lenders scrutinize the details. Pillar number 3 is your credit history length and mix. This is about 15% of your score. Lenders want to see a long, stable history of you managing credit responsibly. The average age of your accounts matters. This is why one of the worst things you can do before applying for a mortgage is closing an old credit card account you don't use. You might think you're being tidy, but you're actually shooting yourself in the foot. When you close that 10-year-old card, you erase a decade of positive payment history and you decrease the average age of all your accounts, making you look like a less experienced borrower. On top of that, you lose that card's credit limit, which means your overall utilization ratio will instantly spike up. Never, ever close your oldest accounts before a mortgage application. The credit mix, which is about 10% of your score, refers to having a healthy blend of different types of credit, like revolving credit, which are credit cards, and installment loans like a car loan or a student loan. This shows lenders you can responsibly manage different kinds of financial obligations. Okay, armed with that knowledge, let's get tactical. Here is the simple 30-day strategy to optimize your credit specifically for a mortgage underwriter's eyes. Week 1 is the audit. You're going to go to annualcreditreport.com. This is the official, government-mandated site, and pull your full credit reports from all 3 bureaus: Equifax, Experian, and TransUnion. Do not just look at your score. You need the full report. Print them out, grab 3 different colored highlighters, and go through every single line item. Are there any late payments that you know were on time? Is there an account listed that you don't recognize? Is a credit limit reported incorrectly? Is a closed account still showing a balance? You are looking for errors. Studies have shown that a shocking number of credit reports contain inaccuracies. Find one and dispute it immediately online through the Bureau's website. An incorrect late payment removal could be worth 100 points. This is the single highest impact thing you can do. Week 2 is the pay down blitz. Look at the utilization ratio on every single one of your credit cards. Your mission is to get every card and your overall total below 10% utilization. If you can't get to 10, get to 20. If you can't get to 20, get under 30. Focus your money here. This might even mean temporarily paying the minimums on a low-interest installment loan to free up cash to hammer down your credit card balances. Remember, we are optimizing for a mortgage application, not long-term interest savings. This is a short-term tactical sprint. Pay down the card with the highest utilization percentage first, not necessarily the highest balance or interest rate. Week 3 is the strategic ask. Once your balances are down, call the credit card companies for your oldest accounts. Ask for a credit limit increase. Use this script. Hi, I've been a loyal customer for X years and I'm updating my financial information. I'd like to request a credit limit increase. Can you tell me if this can be done without a hard inquiry on my credit report? Many companies can do this with a soft pull, which doesn't affect your score. Why do this? Because if they double your credit limit from $5,000 to $10,000, your $1,000 balance just went from 20% utilization down to 10%. instantly. It's a powerful lever to pull. Week 4 is the freeze. For the final week leading up to and during your mortgage application, your credit activity goes on absolute lockdown. Do not apply for any new credit. No new store cars to save 10%, no new car loans, nothing. Every hard inquiry can temporarily dip your score and forces the lender to reevaluate your debt. Don't make any abnormally large purchases on your existing credit cards, even if you plan to pay it off. A new high balance reporting at the wrong time can derail everything. Just let your profile sit. Let the positive changes from the past 3 weeks report to the bureaus and marinate. Now for the secret weapon. Let's say you do all this and your score jumps from a 670 to a 710. But you know that a 720 score would get you into a better interest rate tier, saving you thousands of dollars. The problem is, it can take 30 to 45 days for the credit bureaus to update with your new lower balances. You don't have that time. This is where you use a tool called a rapid rescore. A rapid rescore is a service that your mortgage lender can initiate on your behalf. You provide proof of the change, like a letter from your credit card company showing the new zero balance. And the lender's provider will work to get that information updated with the credit bureaus in as little as 3 to 5 business days. It's not for fixing errors. It's for updating accurate, positive changes quickly. It costs a bit of money, but the return on investment from securing a lower interest rate can be astronomical. Ask your lender about it. Your credit profile is the financial story you present to the world. And in the world of mortgage lending, that story needs to be a bestseller. It needs to scream stability, reliability, and low risk. By focusing on what underwriters actually care about, flawless payment history, rock-bottom utilization, and a long stable track record, you're not just boosting a 3-digit number. You're crafting a narrative that makes a lender eager to invest in you. Now that your credit story is polished and ready, there's another number, a critical ratio that can make or break your entire application, even if you have a perfect 800 credit score. It's the gatekeeper that determines the absolute maximum amount you're allowed to borrow. It's called your debt-to-income ratio, and in the next part we're going to dissect it piece by piece, revealing how you can legally and ethically manage it to qualify for the loan you truly want. So let's pull back the curtain on this mysterious number. Your debt-to-income ratio, or DTI, isn't just a piece of financial jargon. It is the single most important metric a lender uses to predict your future behavior. It's their crystal ball. Tells them, under the pressure of a new large mortgage payment, are you going to bend, or are you going to break? Think of it as a financial stress test. Before they hand you hundreds of thousands of dollars, they need to know you can handle the weight. And this test has 2 distinct parts. First, there's the front-end ratio. This is the simple one. It's also called the housing ratio. It looks at one thing and one thing only: your proposed total housing payment. That means the principal on the loan, the interest, the property taxes, and the homeowner's insurance, what we call PITI. The lender takes that monthly PITI number and divides it by your gross monthly income. That's your income before any taxes are taken out. So if your new mortgage payment is going to be $2,000 and your gross monthly income is $8,000, your front-end ratio is a clean 25%. This number tells the lender what percentage of your paycheck will be immediately consumed by just keeping a roof over your head. But that's only half the story. The real heavyweight champion of mortgage qualification is the back-end ratio. This is the one that trips up most investors. The back-end ratio takes that same proposed housing payment, but then it adds on every other single monthly debt obligation that appears on your credit report. We're talking about your car payments, your student loans, your minimum credit card payments, personal loans, alimony or child support payments, all of it. The lender bundles all of that together, adds it to your future mortgage payment, and then divides that total by your gross monthly income. So in our example, your $2,000 mortgage plus, say, a $500 car payment and $300 in student loan and credit card minimums, that's a total of $2,800 in monthly debt. Divide that by your $8,000 of gross income, and your back-end DTI is 35%. Now, why do these percentages matter? Because every loan program has a secret rulebook with hard limits. For decades, the gold standard for a conventional loan was the 28 of 36 rule. No more than 28% of your income for the house, and no more than 36% for all your debts combined. But times have changed. Today, with automated underwriting systems, those lines have blurred. You can often get approved for a conventional loan with a back-end DTI of 43%, sometimes even up to 50% if you have a huge down payment or massive cash reserves. Government-backed loans like FHA and VA are even more generous, sometimes stretching into the mid-50s. But here's the critical truth. Just because a computer can approve you at 50% DTI doesn't mean you should take it. That's living on the financial edge. Our goal isn't to squeak by. Our goal is to master this number, to control it so that you get the best possible loan with the best possible terms without being financially suffocated. So how do we do it? How do we take control of this ratio? It's a simple fraction. Your total monthly debts divided by your total monthly income. To make the number smaller, you have two levers to pull. You can either increase the bottom number, your income, or decrease the top number, your debt. Let's start with income. Increasing your income seems obvious, right? Get a raise. But a lender won't just take your word for it. They need to see a history of stability. If you're a W-2 employee and you get a salary bump, fantastic. That's instant verifiable income. But what about bonuses, commissions, or overtime? Lenders are cautious. They typically want to see a 2-year history of you consistently receiving that extra income before they'll count it towards your qualification. If you started a side hustle 6 months ago, that's great for your bank account, but it's probably not going to help your DTI calculation today. The key is documentation and consistency. If you want that overtime to count, you need 2 years of pay stubs and W-2s to prove it's a reliable part of your earnings, not a one-time fluke. But for most people, the fastest, most effective way to radically improve your DTI is not by trying to earn more, but by strategically eliminating debt. This is where you can play chess while everyone else is playing checkers. Let's focus on the 3 biggest DTI killers: car loans, student loans, and credit cards. First, the car loan. That shiny new SUV in your driveway might be the single biggest obstacle between you and your first investment property. Let me put this in perspective. A $600 monthly car payment does not just reduce your monthly cash flow by $600. From a lender's perspective, at a 6% interest rate, that single payment reduces your borrowing power by roughly $100,000. Let that sink in. Your car could be costing you a duplex. If you are on the edge of qualifying, the most powerful move you can make is to get that car loan off your books. Pay it off if you can. Sell the car and buy a cheaper one for cash. Do whatever it takes. Eliminating a $500 or $600 payment is like giving yourself a $20,000 a year raise in the eyes of the lender. Next, student loans. This is a minefield for so many Americans. You might be on an income-based repayment plan, or your loans might be in deferment, meaning you aren't currently making payments. You might think, great, my payment is 0, so it won't count against my DTI. Wrong. Dead wrong. Lenders know that payment won't be 0 forever. So, if your credit report shows a 0 payment, they have their own rules. For conventional loans, they will typically take 1% of your total student loan balance and use that as your monthly payment. If you have $100,000 in student debt, they will hit your DTI calculation with a phantom payment of $1,000 a month. That can be an absolute deal killer. FHA loans are a bit more lenient, often using 0.5%. The way to combat this is to get on an official documented income-driven repayment plan, or IDR. If that plan officially sets your payment at, say, $150 a month, the lender is required to use that number, not their own 1% calculation. This single move can save an application. Finally, credit cards. The lender only cares about the minimum monthly payment showing on your credit report. But high balances look risky, and those minimums, even if they're small, add up. The strategy here is simple. Pay them down. Before you even start looking at properties, attack your credit card debt. Use the snowball method, paying off the smallest balances first for psychological wins, or the avalanche method, paying off the highest interest cards first to save the most money. Getting rid of 3 or 4 minimum payments might only free up $100 a month, but it cleans up your credit report and shaves precious points off your DTI. And one final crucial warning. The 3 months before you apply for a mortgage is a financial quiet period. Do not, under any circumstances, do anything that adds a new monthly payment to your name. Don't go finance new furniture for the house you haven't bought yet. Don't co-sign a car loan for your cousin. Don't apply for a new credit card to get a 10% discount at a department store. Any new inquiry or new debt can trigger a red flag in the underwriting system and force your entire file to be reevaluated, potentially derailing your loan at the last second. Be invisible. Keep your finances as boring and predictable as possible. By mastering these levers, documenting your income, and more importantly, systematically attacking and reducing your monthly debt obligations, you transform your DTI from a barrier into a tool. You're no longer asking the bank what they'll give you. You're telling them what you qualify for. You've now passed the stress test. Your income is verified, your credit is clean, and your DTI is lean and powerful. You have the green light. But the lender has one more question, and it's a big one. It's the question of cash. They need to see the money for the down payment and closing costs. But it's not enough to just have the money. They are intensely, almost obsessively, interested in where it came from. Every dollar has to have a story, and in the next part we're going to break down exactly how to document your assets, season your funds, and legally accept gift money without raising a single red flag with the underwriter. So let's become master storytellers of our own finances. The first chapter is your bank statements. Lenders will typically ask for the most recent 2 months of statements for every single account you plan to use for the down payment and closing costs. And I mean every account. This isn't just your primary checking. We're talking savings, money markets, brokerage accounts, even that fintech app where you stash a few $1,000s. If money for this transaction lives there, or has even passed through there, they want to see its full history. And here's what they're really doing. They are scanning for landmines. A landmine in an underwriter's world is any large non-payroll deposit. That $100 your friend paid you back via Venmo for concert tickets? That's fine. But that $5,000 that appeared out of nowhere last Tuesday? That's a giant blinking red flag. That's a 5-alarm fire. Because to a lender, an undocumented deposit isn't just money. It's a potential secret loan. It's an undisclosed debt that doesn't show up on your credit report, which means your entire financial profile, your debt-to-income ratio, could be a complete fabrication. Every dollar needs a birth certificate. If you sold your car for $8,000, you need to provide a copy of the signed title and a bill of sale. If you sold $10,000 worth of stock from your portfolio, you need the brokerage statement showing the sale and the subsequent transfer record into your checking account. The dates and amounts must match perfectly, down to the penny. Think of it like a chain of custody for your cash. Every link must be visible and unbroken. The absolute worst-case scenario is a large cash deposit. Let's be blunt. Underwriters hate cash. It has no story. It has no origin. If you have $10,000 saved in a safe at home, and you deposit it a month before applying for a loan, you have a massive problem. You can't prove where it came from. The underwriter is forced to assume the worst, that it's an illegal gift or an off-the-books loan from someone who expects to be paid back. In most cases, they will completely disregard that money, and you won't be able to use it for your purchase. This brings us to one of the most powerful and misunderstood concepts in mortgage lending: seasoning your funds. This sounds like something you do to a Thanksgiving turkey, but in finance it means letting your money sit in your account for a specific period, typically 60 to 90 days. This conveniently aligns with that 2-month bank statement requirement. Money that has been in your account for longer than that 60-day window is considered seasoned. The lender assumes it's your money, no questions asked. They don't care if you won it in a poker game 3 months ago, or if your grandma gave it to you for your birthday last Christmas. Because it's been sitting there, it's considered a stable, integrated part of your financial picture. The problem, as we discussed, is unseasoned funds, money that just showed up. This is where so many aspiring investors get tripped up. They'll shuffle money around between accounts right before applying, thinking they're getting organized. But what the underwriter sees is erratic activity called churning. Even if it's all your own money, moving large sums between your checking, savings, and investment accounts creates a confusing paper trail that makes them nervous. Here's the pro-level strategy. Plan ahead. Pick the 1 or 2 accounts you will use for your down payment and closing costs. At least 3 months before you apply for a loan, consolidate the funds into those accounts. If you have that $10,000 in cash, deposit it now. Then don't touch it. Let it sit. Let it marinate. Let it season. By the time the lender pulls your 2 months of statements, that deposit will be ancient history, invisible on the documents you provide. The money will be considered yours, free and clear. This simple act of patience and planning demonstrates stability and foresight, 2 traits every lender wants to see in an investor. But what if you don't have all the funds yourself? What if a family member wants to help you secure that first investment property? This is where gift funds come in, and it's a fantastic tool, but it is a minefield of rules. The number 1 non-negotiable, absolute ironclad rule is this: a gift must be a true gift. There can be 0 expectation of repayment ever. If your uncle says, "I'll give you $20,000 for the down payment, just pay me back when you can," that is not a gift. That is an undisclosed loan, and using it is mortgage fraud. Lenders take this so seriously they will prosecute. So, how do you accept a gift the right way? First, you need a gift letter. Your lender will provide the template, but this is a legal document. It must state the giver's name, address, and their relationship to you, the exact dollar amount of the gift, and a crystal-clear, unambiguous statement that the funds are a gift with no expectation of repayment, implied or explicit. Both you and the person giving the gift have to sign it. Second, and even more important, is the paper trail. You have to prove the money moved directly from the giver's account to yours in a clean, traceable line. This means the lender will want to see a copy of the giver's bank statement showing the funds being withdrawn. Yes, the person giving you the money has to be willing to share their bank statement with your lender. Then the lender needs a copy of the wire transfer receipt or a copy of the front and back of the cleared cashier's check. Finally, they need your bank statement showing the exact same amount being deposited. They are forensically tracing the money from point A to point B. I saw a deal almost collapse because a father gave his son $25,000. He pulled the money from his investment account, transferred it to his checking, then wired it to his son. The problem? He didn't provide the statement from his investment account showing the initial withdrawal. The underwriter couldn't verify the ultimate source of the funds. They put the entire loan on hold, threatening to deny it, until the father produced that one extra piece of paper. It caused a week of pure panic and nearly cost them the house over a single missing document. It's also crucial to know who can give a gift. For conventional loans backed by Fannie Mae and Freddie Mac, it typically has to be a family member, a spouse, child, parent, grandparent, sibling. Government-backed loans like FHA are a bit more flexible, sometimes allowing gifts from close friends with a documented interest in your life, or even an employer. But you must never assume. Always check with your specific lender and loan program first. And one last piece of high-level advice to protect the person giving you the gift: be aware of the federal gift tax. As of 2023, an individual can give up to $17,000 to any other individual in a single year without any tax implications. A married couple could give a child $34,000. If the gift is larger than that, the giver may have to file a gift tax return. The tax is on the giver, not you, but it's a conversation you need to have to ensure everyone is protected. By sourcing and seasoning your funds correctly and handling gift money by the book, you're not just providing documents, you're building an airtight case. You're proving to the underwriter that you are a low-risk, reliable, and trustworthy borrower. You're making their job easy, and when you make an underwriter's job easy, they are far more likely to stamp your file with the one word every investor is fighting to hear: approved. Now that you've built the perfect financial file, proving you are a worthy borrower, the focus shifts. Because you're not the only one being scrutinized. The property itself is about to go under the microscope in a process that holds the power to kill your deal in an instant, regardless of how perfect your finances are. The appraisal. And how that number comes in can change everything. Everything. The loan amount, your down payment, even the entire deal itself. The appraisal isn't just a formality. It's the lender's single most important reality check. Think about it from their perspective. They're about to hand over hundreds of thousands of dollars, and your promise to pay it back is only half the equation. The other half is the collateral, the property itself. If you stop making payments, the lender needs to know with absolute certainty that they can sell that house and get their money back. The property is their insurance policy, and the appraisal is the document that sets the value of that policy. This is why you don't get to choose your appraiser. Your real estate agent doesn't choose them. The seller certainly doesn't choose them. To ensure complete impartiality and avoid any conflicts of interest, the lender orders the appraisal through a third-party entity called an appraisal management company, or AMC. They act as a firewall, randomly assigning a licensed local appraiser from their pool. This person has one job and one job only: to provide an independent, unbiased, professional opinion of the property's fair market value. They have no stake in whether your deal closes or not. Their only allegiance is to the data. So what actually happens? Once the appraiser accepts the assignment, they schedule a visit to the property. And let's be crystal clear about something. An appraiser is not a home inspector. They aren't going to run the dishwasher, check the foundation for cracks, or test the electrical outlets. Their focus is on features that affect value. They will walk through every single room, measuring the gross living area down to the inch. They'll count the number of bedrooms and bathrooms. They'll note the overall condition. Is it pristine or a fixer-upper? They'll assess the quality of construction, the age of the home, and the functionality of the layout. They're documenting upgrades, a remodeled kitchen, new windows, a finished basement. They're also noting any obvious defects or issues that could negatively impact the value. like a failing roof or significant water damage. They take dozens of photos inside and out, creating a detailed record of the property's state on that specific day. But the physical inspection is only the beginning. The real work happens back at their office. The appraiser becomes a financial detective, and their primary mission is to find comparable sales, or what everyone in the industry calls comps. They are searching for the Holy Grail. 3 to 5 homes that are as similar as possible to your property, in the same neighborhood, that have sold within the last 90 to 180 days. The closer, the more recent, and the more similar, the better the comp. This is where the art and science of appraising truly merge. No two houses are identical, so the appraiser has to make adjustments. This is a methodical process of adding or subtracting value from the comparable property's sale price to make it equivalent to your subject property. For example, let's say your target property is a 2,000 square foot home with a 2-car garage. They find a comp down the street that just sold for $400,000, but it's only 1,800 square feet and has a 1-car garage. The appraiser will make a positive adjustment to that $400,000 price to account for the extra 200 square feet and the extra garage bay your property has. Conversely, if another comp sold for $420,000, but it has a brand new swimming pool and your property doesn't, they'll make a negative adjustment, subtracting the typical value of a pool in that market. They do this for every significant difference: bathrooms, lot size, condition, upgrades, until they have an adjusted value for each comp. Finally, they reconcile these adjusted values, weighing the best and most recent comps more heavily, to arrive at a single final opinion of value. This number, along with all the supporting data, photos, and analysis, is compiled into a comprehensive report and sent directly to the lender. And that's when you, the investor, get the news. Your fate hangs on this one number, and it can lead to one of 3 very different outcomes. Scenario 1 is the dream. The appraisal comes in at value or even higher. Your purchase price is $500,000, and the appraiser says the property is worth $500,000, or maybe even $510,000. Hallelujah! The lender is satisfied, the collateral is secure, and the loan process continues to move forward without a hitch. This is what's supposed to happen in a stable, fairly priced market. Everyone breathes a collective sigh of relief. But then there's scenario 2, the one that strikes fear into the heart of every buyer. The appraisal comes in low. Your purchase price is $500,000, but the appraiser's report comes back with a value of $480,000. The deal comes to a screeching halt. Why? Because the lender will only base their loan on the lesser of the purchase price or the appraised value. They see that $20,000 difference, the appraisal gap, as you overpaying. They will not finance your mistake. Their loan calculation is now based on a $480,000 value, not $500,000. This creates a significant shortfall, and you now have 5 potential paths forward. First, you can make up the difference in cash. You would need to bring your original down payment, plus the entire $20,000 gap, to the closing table. For many investors, this unexpected cash outlay can be a deal breaker. Second, you can go back to the seller and renegotiate the price. Armed with the appraisal report as powerful leverage, you can say, look, an independent professional has determined your home is only worth $480,000. We need you to lower the price to match the appraisal. A motivated seller might agree. Third, you can meet in the middle. You offer to bring an extra $10,000 to closing if the seller agrees to reduce the price by $10,000. This splits the difference and can often save a deal. Fourth, you can challenge the appraisal. This is called a reconsideration of value, and it's a long shot. You can't just say you disagree with the appraiser's opinion. You and your agent must provide concrete, factual evidence of errors. Did they miscalculate the square footage? Did they miss a 4th bedroom? Did they use comps from a completely different, less desirable neighborhood? If you can prove a factual mistake, the lender may order a revision or a new appraisal. Finally, if you have an appraisal contingency in your contract and you can't come to an agreement with the seller, you can walk away from the deal entirely and, in most cases, get your earnest money deposit back. This contingency is your ultimate escape hatch. This is why, as an investor, you must be proactive. Never, ever waive your appraisal contingency unless you have a mountain of cash and are fully prepared to cover any potential gap, no matter how large. In a bidding war, it's a tempting way to make your offer stand out, but it's a massive financial risk. Before you even make an offer, have your real estate agent run a comparative market analysis to get a solid estimate of the property's true value. This prevents you from getting into a low appraisal situation in the first place. And here's a pro-level tip. Prepare an appraiser packet. Have your agent meet the appraiser at the property with a small professional binder. Inside, include a list of all recent upgrades and improvements with their approximate costs, a plat map of the property, and maybe even a list of a few comparable sales that you believe support your offer price. You're not telling them how to do their job. You are respectfully providing them with organized, helpful information to make their job easier and ensure no value-adding feature is overlooked. So the appraisal comes in at value, you've navigated the negotiation, and the lender gives the thumbs up. You're practically celebrating, picturing the keys in your hand. But hold on. The gatekeepers of the vault have one last look. This is the final boss battle of the mortgage process. Final underwriting. And it's during this last silent, nerve-wracking phase that many deals unexpectedly die. Because what you do in the days leading up to closing can undo everything you've worked for. You've navigated the inspections, the appraisal came in strong, and you've received that glorious email with the words, "Conditionally approved." You feel like you're on the 1-yard line, ready to spike the football. But this is the most dangerous part of the entire game. The lender has put the loan file on the desk of a final underwriter, a senior-level detective whose only job is to look for a reason to say no. They will re-verify everything. Your job, your credit, your bank accounts, it all goes back under the microscope. This is the quiet period, the radio silence before the storm of closing, and what you do here is absolutely critical. So let's talk about the 7 deadly sins of the pre-closing period. These are the actions that can snatch defeat from the jaws of victory. First, and most importantly, do not change your employment status. Do not quit your job. Do not switch jobs. I don't care if you've been offered your dream position with a corner office and a $50,000 raise. If you change your employment, the entire verification process has to start from scratch. The underwriter needs to see stability. A brand new job, even a better one, is the definition of instability. They'll need new pay stubs, they'll have to re-verify your employment, and a new probationary period could disqualify you entirely. Stay put until the keys are in your hand. Second, do not make any large purchases, especially on credit. This is the classic heartbreaking mistake. You're excited about the new house, so you go out and buy a new truck to park in the driveway, or a whole new living room set from a furniture store offering 0% financing. What you just did was detonate a bomb in the middle of your debt-to-income ratio. The lender will pull your credit one final time, often just hours before closing. When they see that new $500 a month truck payment that wasn't there before, your DTI can shoot past the acceptable limit, and the loan is denied. The deal is dead. All of your new furniture is now sitting in a storage unit while you're stuck in your old apartment. Put the credit card in a block of ice and wait. Third, do not open or close any lines of credit. Don't apply for a new credit card to get the sign-up bonus. Don't close that old credit card you never use. Opening a new account triggers a hard inquiry, which can ding your credit score. More importantly, it lowers the average age of your credit history, which can also drop your score. Closing an old account might seem smart, but it can actually hurt you more. It reduces your total available credit, which can instantly increase your credit utilization ratio, a key factor in your credit score. If your score drops by even a few points, you could lose your favorable interest rate or even the loan itself. Your credit profile needs to be frozen in carbonite. Don't touch it. Fourth, do not move large sums of money around without a clear paper trail. Underwriters are terrified of undocumented cash. A sudden unexplained $5,000 deposit into your checking account a week before closing is a giant red flag. To them, it doesn't look like a gift from your parents. It looks like an undisclosed loan from a friend that you'll have to pay back, which is another secret debt that wasn't factored into your DTI. Every single dollar for your down payment and closing costs must be seasoned, meaning it's been sitting in your account for at least 2 months, or it must be meticulously sourced. If your grandma gives you a cash gift, it needs to be accompanied by a formal gift letter, a copy of her bank statement showing the withdrawal, and a copy of your deposit slip. Don't deposit cash. Keep your finances clean and boring. Fifth, don't miss any payments. This seems obvious, but in the chaos of preparing to move, it's easy to forget a simple credit card bill or a car payment. Set everything you have to auto-pay. A last-minute late payment reported to the credit bureaus can be a fatal blow. It shows financial irresponsibility right at the moment you need to look like the safest bet on the planet. Sixth, do not co-sign a loan for anyone. Not for your brother, your cousin, or your best friend. Even if they swear on a stack of Bibles they'll make every payment, in the eyes of the lender, that debt is 100% yours. When you co-sign, their car loan or personal loan appears on your credit report as your liability, which again can wreck your DTI and kill your mortgage approval. And the seventh and final sin: don't ignore requests from your lender or be less than 100% truthful. If the underwriter asks for one last bank statement or an explanation for a credit inquiry, get it to them immediately. The longer you wait, the more you risk delaying your closing. And never, ever lie or omit information. They are professional secret finders. They will find that undisclosed alimony payment or that old tax lien. A last-minute discovery of dishonesty is the fastest way to get your file stamped denied. If you can avoid these 7 sins, you will survive the final underwriting. And then you'll get the 3 most beautiful words in the English language. Clear to close. This is the official green light. The underwriter has given their final blessing. At this point, the title company and your lender will coordinate to produce the single most important document you'll see at the end of this process: the closing disclosure, or CD. By federal law, you must receive this document at least 3 business days before your scheduled closing. This is your final chance to review all the numbers. Check the interest rate, the loan term, the spelling of your name. But your eyes should go directly to the bottom line: the cash to close figure. This is the exact amount of money, down to the penny, that you need to bring to the closing table. It will be a certified check or, more commonly, a wire transfer. Triple check the wiring instructions with the title company over the phone to avoid wire fraud. Now for the closing itself. You'll walk into a conference room at a title company or an attorney's office. You, the closing agent, and maybe your real estate agent will be there. You'll be presented with a stack of documents that looks like a phone book for a small city. Don't be intimidated. You're going to sign your name until your hand cramps. But there are 3 key documents to understand. First is the promissory note. This is your IOU to the bank. It states the amount you're borrowing, the interest rate, the dates your payments are due, and where to send the payment. This is the document that legally obligates you to repay the loan. Second is the mortgage, or in some states, the deed of trust. This is the security instrument. This is the document that says, if I don't pay my promissory note, the lender has the right to take my property through foreclosure. It links the debt to the house itself. And third, you will sign a final version of the closing disclosure, confirming that you agree with all the fees and figures. You'll sign and you'll sign and you'll sign. And when the last page is signed, the closing agent will say, "Congratulations." The lender will be notified, and they will authorize the wire transfer to fund the loan. Once the seller's side confirms they have the money, the deal is officially funded and recorded with the county. And then it happens. The moment you've been working towards for months. The title agent slides a small manila envelope across the table. Inside are the keys to your property. It's yours. The stress, the paperwork, the endless waiting. It all melts away in that one single triumphant moment. You've done it. You've successfully navigated the mortgage maze and acquired an asset. But as you stand in the empty living room of your new investment property, a new reality begins to set in. The journey isn't over. In fact, it's just beginning. Because within a week or 2, you're going to get a letter in the mail. It might be a welcome letter from your lender, or it might be a goodbye letter, informing you that your loan has already been sold to a completely different company. Your first payment is due in just a few weeks. You now have to manage this asset, this debt, and this new business. The game has changed. You're no longer just a borrower. You're a real estate investor. And what you do in the first 90 days of ownership will set the stage for your entire investment career. So let's break down that 90-day roadmap, your blueprint for turning a signed mortgage into a successful investment. This isn't just about collecting a rent check. It's about establishing control, stabilizing your asset, and setting it on a path for long-term growth. Day 1. The clock starts the second those keys are in your hand. Your first priority is security, not just for the property but for your investment. That means changing the locks. Immediately. You have no idea who the previous owner, their tenants, or their contractors gave copies to. This is a non-negotiable Day 1 task. Next, you're transferring all utilities into your name or your business entity's name. Water, electric, gas, trash. Do not rely on the seller or previous tenants to do this. Take ownership. This prevents service interruptions and establishes a clear financial paper trail from the very beginning. If the property is occupied, this is also the day you make your first official communication with your tenants. This isn't just an email. It's a formal introduction letter. It states who you are, confirms you are the new owner, and most importantly, provides crystal clear instructions on how and where to pay rent going forward. You want to make this transition seamless for them. Any confusion about rent payment is a problem you created, not them. Now we move into the first 30 days. This is your stabilization and deep dive phase. You had an inspection before you bought, but that was a snapshot. Now you need to conduct your own owner's audit. You're going to walk the property with a fine-tooth comb. You're not just looking for problems. You're looking for the story the property is telling you. You'll open every cabinet, turn on every faucet, test every outlet, and run every appliance. You'll document everything with photos and notes, creating a master punch list. Categorize this list into 3 levels of urgency: critical safety issues that need immediate attention, necessary repairs that can be scheduled, and future upgrades that can add value down the line. Simultaneously, you're setting up your financial command center. This means opening a dedicated business checking account solely for this property. Every single dollar of rent goes into this account, and every single expense from the mortgage payment to a replacement light bulb comes out of it. There is no commingling of funds. This isn't just a good idea for taxes. It's the bedrock of running a professional operation. It allows you to see the true financial health of your investment at a glance. You'll also set up your accounting system. This can be a simple spreadsheet or dedicated software like Stessa or QuickBooks. Track everything, every penny. The professional investor is a master of their numbers. The final piece of your first 30 days is building your team. Don't wait for a 2 a.m. call about a burst pipe to start looking for a plumber. Proactively build your list of go-to vendors. Find a reliable handyman, a licensed electrician, a plumber, and an HVAC technician. Get their contact information, check their references, and understand their rates before you need them. This network is one of the most valuable assets you will build as an investor. Now we enter days 31 through 90. This is the optimization phase. You're moving from reactive to proactive. You'll take that detailed punch list you created and start executing. Tackle the critical safety and deferred maintenance items first. Fixing a small leak under the sink today prevents you from replacing the entire subfloor and cabinetry next year. These early actions build momentum and prevent small problems from becoming catastrophic, budget-destroying failures. This is also where you refine the tenant experience. If there are existing tenants, address any maintenance requests they might have had that were ignored by the previous owner. A small, quick repair can build immense goodwill, turning an average tenant into a long-term, reliable customer who treats your property with respect. Happy tenants are less likely to leave, and vacancy is the single biggest killer of profit in rental real estate. During this phase, you also begin planning for the future. I'm talking about capital expenditures or CapEx. These are the big-ticket items: the roof, the HVAC system, the water heater, the windows. They have a finite lifespan. You need to identify the age and condition of each of these major systems and start budgeting for their eventual replacement. Open a separate savings account and automatically transfer a portion of the monthly rent into it. This isn't a nice-to-have, it's a necessity. Amateurs get wiped out by a surprise $10,000 roof replacement. Professionals plan for it. Finally, you'll perform a new market analysis. You did one to buy the property, but now you're analyzing it as an operator. Are your rents truly at market value? What are comparable properties renting for right now? What amenities are they offering? This research will inform your strategy for when a lease comes up for renewal. It helps you decide whether a rent increase is justified and what small cost-effective upgrades, like new light fixtures or a smart thermostat, could allow you to command a higher rent and attract better tenants in the future. By the end of these 90 days, you have fundamentally transformed your position. You've moved from being a passive borrower to an active business owner. You've established control, stabilized the physical and financial aspects of the asset, and created a strategic plan for its future. The mortgage, which once seemed like the entire mountain to climb, is now just one line item on your profit and loss statement. It's a tool, a form of leverage you use to acquire a cash-flowing asset. Throughout this entire series, we've journeyed from the very foundations of credit and income to the complex dance of underwriting and closing. We've demystified the jargon, broken down the numbers, and given you the strategies to navigate one of the most significant financial transactions of your life. But the ultimate lesson is this: securing the loan isn't the finish line. It's the starting gun. The property itself is just 4 walls and a roof. The mortgage is just a contract with a bank. The real investment, the one that will generate wealth for you and your family for decades to come, is the business you build around that property. It's the systems you create, the team you assemble, and the strategic decisions you make starting on day one. You now have the knowledge. You understand how the machine works from the inside out. You know how to prepare, how to apply, how to negotiate, and now how to operate. The path from aspiring investor to successful portfolio owner is no longer a mystery. It's a process, and you are now equipped to master it. The keys are in your hand. The loan is simply the fuel. Your knowledge, your discipline, and your execution, that is the engine. Now go out there and build your future.